Hi everyone. I just wanted to share with you a conversation I had with a client yesterday, actually from somebody from this group. She asked me whether or not it's a good idea to break the current high interest rate mortgage that she's in right now for a lower rate mortgage that we have access to today. Now, it's a very good question. I think that question is applicable to most clients that have a mortgage today. Now, there's a few things that we need to consider. Are you working today? What's your current income? What's the value of your property? What's the current balance of your mortgage and the interest rate that we're looking to compare it to? We have to determine whether or not you're gonna have a 3 month penalty interest, or what we call an IRD, interest rate differential. Now, all in all, we need to understand that you need to qualify for a new mortgage today. So if you're in a position where your credit history or income or maybe the value of the property is not strong enough to get us a refinance, unfortunately, that's something that we may have to fix first and then consider going forward with a potential breaking the current mortgage to take advantage of the lower rates today. Now, if it's okay with you, let's go through an example. Let's say you have a mortgage of around 500,000, which is really not a big mortgage considering the price of values, the properties in the GTA today. Now, assuming that you have a mortgage of around 3.5%, your cost of interest annually is the basic cost is approximately around 17,500. Simple enough to figure out. Now, if we compare that to a current mortgage rate that we have access to for, let's say, a 5-year variable rate, you're looking at around 2.2%. And at that rate, your interest cost for that would be around $11,000 per year. So clearly, the lower interest rate will cost you less. That's around 6,500 per year savings. Now, that's not the only thing that we really have to take into account. We have to take into account the exit cost. So what is that? That's the penalty to leave your current mortgage and a discharge fee that the banks charge you. So that's around 4,000, let's say 4,375. If it's a 3 months interest, then if we add on a $300 discharge fee, so that's around 4,675. So what does that mean? So if your penalty is only 3 months interest, which is 4,675, and compare that to the 6,500 cost savings that you will get, clearly within a year, you're already in an advantage position to leave the current mortgage and consider the current lower rates. Now, that's assuming it's IRD interest. That's assuming it's 3 months interest. Now, IRD is a little bit different. IRD is interest rate differential. So it's a little bit more complicated to consider, and each bank treat it a little bit differently. But really what we look at is the current balance, the current interest rate that you have contracted versus the interest rate offerings that they're providing right now, and how many more months left in your term. So the longer the term that's left, the higher the potentially the penalty could be. So if your penalty is in the $10,000 to $15,000 for the IRD, interest rate differential, it may still make sense, but it could take over a year for you to recoup that penalty. So it might take a year to 2 years, but if you're in a 5-year fixed term or a 5-year variable term, after the 2 years, so on year 3, year 4, and year 5, technically that's your advantage. So yes, it's a scenario that you should definitely consider. I would say in general today, if your current interest rate is at around 3% or higher, definitely reach out to your expert mortgage agent to basically work on the particulars on whether or not it makes sense for you. There's also some added benefits to it. you get to be a free agent, right? So the new mortgage, because you're refinancing, the new mortgage, you can take it anywhere. Whether or not you stay with the bank that you're currently in right now, that's certainly an option, or move it to another bank or another mortgage institution. That's definitely in the works. Now, you can also negotiate your term. So if you think that, going even longer term, so if you had, 2 years left on your current term and you wanted to go extend that to a 5 year, certainly you have the option to go to a new 5 year term or make it even shorter. So if you said, you know what, Ray, I'm going to consider moving in 2 years. Well, we can match it up by going with a 2 year term. You can also basically decide to go into a fix or a variable, right? So depending on what your preference is today, you can go to a variable or you can go to a fix. You can consolidate some higher interest loans. So if you have any unsecured loans or credit cards or even car loans that you want to consolidate into it, certainly makes sense to go consolidate into a lower interest rate mortgage. You can also reset your amortization. So sometimes this is a good motivation as well to refinance. So if you're, in a shorter term amortization and currently you want to lower the minimum payment, you can certainly stretch that back up to 30 years for most cases. Or the other way around, where you're thinking, you know what, Ray, I'm closer to retirement and maybe I want to shorten it a little bit more. We have the opportunity to do that as well. So, like I said, to sum it up, generally, I would say, yes, it's definitely good to consider it. Look at your current mortgage statement. If it starts with a 3, call your expert mortgage agents, give us a call, and definitely we'll go through a little bit more detail with you to see whether or not it makes sense to do that today. Again, thank you for listening. And I know that we're still in the middle of pandemic here, so wear your mask when you go outside. We're here, we're available if you have any questions. Thank you.